I am Carla Barker. I am a licensed realtor here in the state of California. I'm also licensed in Maryland. I got introduced to development by working in affordable housing in San Francisco, where I was tasked with finding buyers for developers' BMR units, which means below market rate units. And so I would do a lot of their outreach and their first-time homebuyer seminars. And so I got to learn a lot about development in San Francisco, the processes and the players and how it happens, and sometimes how it doesn't happen. So happy to be here and introduce Lawrence, Dwight, and Bill. Lawrence, why don't you go next?
Hi, I'm Lawrence Jacek. I'm managing principal of CRE Development Capital. I'm happy to be here with this group.
Thank you. Dwight?
And I am Dwight Alexander, the co-managing principal at CRE Development Capital. Like yourself, Carla, I have kind of gone through the gamut with regard to my education with regard to development. I'm an attorney by training, spent several years practicing law, and then spent another 13 years as an investment banker, financing mostly stadiums and arenas, sports facilities all over the country, including the Oakland Coliseum, where the Raiders used to play and where the Warriors used to play. And then have spent, the last 20 years as a lobbyist for financial institutions with regard to investments and other things dealing with Congress and the administration. The other distinction that I have, where I probably got, probably the biggest education and development, was that I was the president of the San Francisco City and County San Francisco Planning Commission for 4 years. And so every major skyscraper from,
Whoa.
that is up in San Francisco now, I had to approve and we went through it. So it was a painstaking process, and I learned a lot in that process with regard to how projects are put together, what makes a project successful.
Mr. Neville.
Hi, my name is Bill Neville, and I am Business Development Manager with the Entrust Group, and we are a custodian and record keeper of self-directed retirement accounts. And in short, what a self-directed retirement account is simply an IRA or a 401k that you hold with a custodian. Entrust would be the custodian that allows for investments in non-traditional assets like real estate, precious metals, private placements, promissory notes, tax liens, et cetera, et cetera. I could go on and on. In short, most people have a retirement account and have it with a bank or brokerage firm. And those banks and brokerage firms limit you to only investing in publicly traded stocks, bonds, and mutual funds. But the IRS doesn't limit you. You're allowed to invest in almost anything you want inside your retirement account, but you have to have your account with a custodian who is willing and able to process whatever investment it is that you want to make. And that's where the Entrust Group comes in.
Great, thanks. So Lawrence, kick us off. And for the lay investor who perhaps has never done a large scale development project or made an investment of any substantial size, walk us through the process of sourcing a development deal, a large scale development deal. Like, where does it start? You're driving down the street, you see this empty lot, and then 2 years later, it's a high rise with commercial on the bottom and all the bells and whistles of modern urban living. How does it come to be?
You said it all right there.
Not around here.
I was out for a run one day, saw this empty lot, and had a great idea. No. Yeah. I mean, sometimes that's how it starts. I've actually found property that way. And
Wow.
Back in the days when I used to run every evening and I'd collect my thoughts, and I'd come across a piece of property that I go by over and over and over again and see it for a couple of years and say, what's going on with this thing? And so all of a sudden, you knock on a door or two and you start to, dig in and see what's going on. And those are some of the best deals because they're off market. It's just an empty lot, and you see a lot of things going up around it, and you're looking at yourself like, what's going on with this? So we found a lot of properties that way, and so that's the beginning.
Right.
And I think the alternative to that is, maybe you see a building and you see a building in a space and you think, you know what, there's a better use for this space than what is currently here.
Mm.
Maybe it's a warehouse and you think, wow, really, other parts of the area are starting to close in on this space, and this space might be better used for something else, whether it's an office use or a residential use or something of that nature. And then that begins the process of saying, okay, we now have this parcel and we want to do something with it that's different than what it had been currently used for or historically used for. And then that begins a whole nother process and sort of a visioning process. Okay, what would be possible here, and what makes market sense to put on this property? And it's almost like, people own homes and you decide whether or not you want to do a renovation.
Right.
You're thinking, and you're like, well, okay, one, is the renovation going to be something that will be marketable or saleable, or is it just something that's a comfort for myself, right?
Right.
So that if I put this in the home, does it increase the value of the home, or does it just make it more comfortable for me? And I think what we look at when we look at property is, can we increase the value of this property by what we put on it, or what we do with it, or what we do with the use of it? And I think that's a big piece of how we look at properties and look at different things. It's just what we can put in and what we can get out. If I can put $5 in and get $50 out, that's a good return, and that's a good investment. And a lot of times it's like that. It is multiples like that. Now, but it takes time to get there. It takes time to get those things. And so that if you have to start and you go through and you have to do a zoning change, or a density change or something of that nature, or a height change, those things take time, and you have to work through, and you go through public meetings, and you go through a whole process. And so that's why the multiples on the investments can be so high, the return can be so high on development, because of the time that it takes to actually get some of these things done.
And give a little bit more information about, the due diligence process.
Well, I think a lot of it starts, from the very beginning. It's like looking at the property. It's like, okay, what does the city or the county or the locale say I can do with this property? Does it say this is farmland? Okay, this is farmland. Now if it says it's farmland, I know that I just have a piece of farmland, but I want to build, houses on this farmland.
Okay.
So then I have to go down to the city and say, okay, what is the possibility of me building houses on this farmland? And you're like, oh, this is a farm reserve for the next 100 years, and it's never going to be moved. So right then and there that doesn't work.
Right.
Right. But if you get a place and you're like, well, there's some other people that have done things, and things that have been done, and zonings have been changed to allow this type. So then you can start that process. And then it's like, okay, well, what's on this land? Did it used to be an old paint factory, and is it considered contaminated or something like that?
Right.
Why it's vacant?
Right.
So then you have to do that environmental look to make sure that you don't have some, residual environmental liability that you get down this process, and then you get in the dirt and you go, oh my, I've got other issues here, and that really doesn't make a lot of sense. And so there are a lot of things, there are a lot of little things along the way that you have to begin to look at and consider. And we kind of sit and go through those checklists, and we get other consultants who do that and go through those checklists, and we painstakingly make sure that what we're going to be able to do, what we want to do with a particular piece of property, we can actually get done, both in terms of the property itself and also in terms of the market and what the market's looking for.
Right.
And no two projects are the same. There's the due diligence list is similar for each one of these, but every time we do one, our due diligence list gets longer. There's always other items, things that you think you thought of everything, and then you come across something new, and that's really where you earn your money, is how to get through these hurdles,
right,
and
solve these problems.
Yeah, it's a big puzzle, but it's for us it's invigorating. It's really exciting. So
okay,
yeah. And
so once you've sourced the deal, done your due diligence, all lights are green, you're ready to go, you don't have any money. Talk me through the.
Hey, Bill.
But before you get there, right? Once we sort of sourced it, figured it out, and kind of gotten the city to go okay with it, but before we even go to the city to ask them about the entitlement, we have to run numbers. We have to make sure what it is we think we can put there, and what it is and the cost that we think it's going to take us to get it there actually makes sense and can provide a competitive market return.
Okay.
And I think that's it's the same with any investor. If someone investing in this fund, you have to go, okay, how is my money going to be treated here versus some other investment that I put in?
Okay.
We have to do that as an opportunity cost. It's like, what do we, in terms of when we're looking at what we're investing in, it's like, well, okay, over here, I might get a multiple of 2. Over here, I'm getting a multiple of 10. And in the grand scheme of things, because of the process that we've gone through, it's much less risky to do that, even though the return is higher. We have much more certainty about what we're going to be able to do on the returns. And so we spend a lot of time running numbers and looking at construction numbers and looking at, contingencies. Contingency. It's always, kind of the Boy Scout motto of be prepared. So we're always trying to be prepared and always trying to assume the worst. And if the worst happens, how do we still get the return one that we want as investors, and then the people who invest in our projects are going to get? And so that's how we run our numbers. And then we go to Bill.
Gotcha.
Bill.
Yeah. But that's the thing. We put together a deep feasibility study on every project. And again, no two projects are alike, and these feasibility studies take a lot of time. And there's a lot of different characters to each property that you have to look at, and then bring in the investors, right? And you really have to think about the investors, and the investors are first.
Right.
They have to be protected, and we need to know that they can weather the storm if the storm hits. Because nobody knows when the storm is going to hit. So we have to build these in, and we model and model for everything. And now we have a new thing to model for, possibly a pandemic. Who knows if another pandemic will hit now or 100 years from now? But we're going to model for it.
Sure.
And one of the things that we do is probably, I like a better term, is peer review. Like, we do our model, we do our internal model, but we have other people validate our models.
Well, that's interesting.
Because look, you can look in the mirror and talk to yourself. You're absolutely beautiful.
I got this.
And then you walk away. You walk away, and your child says, "Hey, Dad, that doesn't really match. That doesn't really work."
You're wearing your pajama bottoms.
That's right.
And so we think that's a very important process. It's very important to have other people look at that and not just it be yourself in your own project, because you can do anything.
For sure.
That's an area of rigor that we undertake.
And so with that information and that level of confidence, you take the package, you take the deal out to the investor market. And so what does that look like? And then Bill, you can respond, this can be a volley between the three of you as to like what that dialogue, what that dance looks like.
We're a service provider.
Sure.
So we provide custodial and record keeping services for people who want to invest in non-traditional assets. So basically anything other than a stock, bond, or mutual fund. So like your syndicated deals, or just if they want to invest in real estate directly inside their retirement account, they're welcome to do that. And we'll provide the service, we'll be the custodian, and we'll provide all the services to enable them to do that inside their retirement account. But it's ultimately up to the individual to go and find the investment themselves and come to us. So largely, it's going to be people that you're talking to, that you're working with, where you bring awareness to them more often than not that, hey, did you know you can do this inside a retirement account? That their interest gets piqued. And they said, I didn't know I could do that. I thought I could only invest in, this suite of funds that Merrill Lynch is offering to me. How do I do that? And then that's when you say, well, call Bill, because he'll explain everything to you and they provide the service to you. Well, that being said, I'm going to add a caveat to that. We have created a marketplace of investment opportunities that our existing account holders are able to access and see within when they log into their account. And we've created this is relatively new for us in the last couple of years. It's called Entrust Connect is what we call it, that allows for investment sponsors such as yourself to potentially market your investment or promote your investment to our existing database of account holders. But we have a disclosure that comes up before they see that says, we've done no due diligence on these investments. We have no relationship with these investment sponsors. They don't pay us anything. We don't speak to the validity of these investments or the quality of it. You have to do your own due diligence. What these are, what this marketplace is a list of investments that other Entrust clients have already invested in.
We were talking earlier offline here, and I am surprised at how many people don't know about this feature. It's really amazing. And, they all talk about want to diversify and invest in real estate, but you make a lot of good points there, Bill, that, there's very little education around the options that they have. And so, we'll tell people, hey, look, if you have a self-directed IRA, or a 401k, there's a possibility there that you could use that to invest in real estate. Again, we're not advisors either.
Right.
When they ask us, can we use this? We'll say yes, but you need to talk to your advisor. And so,
right. Actually, we tell people they should talk to an advisor as well before they make any investment decision. But I mean, yeah, if what ultimately I tell people is, if you want to invest in something other than just a mutual fund or some, from whatever suite of funds that Merrill Lynch is selling to, or Vanguard, or whoever it is, the IRS allows it, right? I mean, ultimately, that's what it comes down to, is within a retirement account, you're allowed to invest in a lot more things than just that list of like funds that your brokerage firm is telling you that they're willing to hold. Like they're not saying these are the only things you're allowed to invest in. What it is those are the only things you're allowed to invest with them as the custodian.
Right.
But if you change your custodian, and particularly if you go to a self-directed custodian like Entrust, all of a sudden a whole world of opportunities open up. You can hold actual real estate. You could buy a rental property and own a rental property inside your retirement account. Now, there are rules around what's considered self-dealing, around, being able to use that property yourself, or work on that property yourself. Like there's certain restrictions associated with that. But the only things you're not allowed to invest in a retirement account, there's only three things: collectibles, life insurance. So collectibles being like art or alcoholic beverages or like coin collections, right? You can't invest in collectibles. Life insurance, and S corporations. Corporations that are structured as S corporations. You can invest in LLCs and C corps and limited partnerships and like all kinds of corporate structures except S corporations. So if you guys were holding your, structuring this investment through an S corp rather than an LLC, an IRA wouldn't be allowed to invest in it, because that's one of the restrictions. But those are the only three things. So, I mean, we had somebody invest in a racehorse, in an airplane, in a bowling alley. Like the list of things that people have invested in is significant. And the only thing that is, as long as they're not engaging in self-dealing. So you had mentioned farmland as something that you might see farmland and consider doing something. We've had people who have invested in farmland, but one of the restrictions is they can't work on the land themselves, right? There's this sort of self-dealing thing that gets into it, but you can certainly invest in farmland as an example inside your retirement account. But people who probably the largest asset class held inside self-directed IRAs is definitely real estate. But within that sort of global category of real estate, I would say the biggest actual structure is what you guys are doing, which is essentially a syndicator who is creating an LLC and bringing in a bunch of investors in the LLC. And now that LLC is going to turn around and buy the real estate. So in effect, they're holding real estate, but the direct holding within the retirement account is into a private placement. It's into an LLC, right? They're not holding direct title on real estate inside the retirement account. So your guys' structure is, from my standpoint, it's perfectly suited for retirement account investors. Like it's the exact kind of structure where they're not necessarily holding direct title on real estate, but they have to deal with renters or, like the maintenance and things like that. They're associated with holding real estate. Like you guys are covering that. It's essentially a passive investment into a fund, except that it's a private fund. It's not exchange traded. It's not publicly traded. And so, Merrill Lynch isn't going to list your fund because it just doesn't meet the qualifications that they do to sell that fund. I'm not picking on Merrill Lynch, right? I'm just using them as a term for all brokerage firms, right? So I think from a standpoint of like your type of investment is one that is without question. And by type, I mean, an LLC that's turning around investing in real estate is extremely popular asset type that's held inside self-directed retirement accounts.
Yeah, and for someone who doesn't have, who's in the Bay Area, who's working a job, a tech job, who has a certain amount of money, $250,000, and wants to make this investment, but doesn't want to be, like you just said, the hands-on, landlord who's fixing plumbing and roofs and all of those things. explain why this is such a more turnkey and easier investment for somebody who wants to invest in real estate, but who doesn't necessarily want the headaches of being a landlord.
Well, that's great. A great, it's a great question and a great a segue into what I was going to say next. But this is, people who don't want to have all those responsibilities but want to capture the upside of investing in a development project. That's what we're providing, right? And so you're a passive investor, but you're going to get much better returns than if you invested into a REIT, for example, or a publicly traded REIT. There's private REITs, there's publicly traded REITs, and those returns, it could be in the 20% IRR, 18% IRR, 16% IRR, 15%. Even if you're getting 12% IRR, you're doing a lot better than most investments on average, right? And then there's potential in the profit share at the end once the property sells. So your chances to potentially double, triple, or even quadruple your money are there. Whereas if it's in a REIT, it might take you 20, 30 years to get that double, triple return, because they're set up much differently than what a real estate development is set up for. So for the funds that we're offering right now, the investments we're offering right now, so the minimum on the smaller funds is 50,000, and the minimum on the larger funds is 100,000. We kept those minimums quite low because of the fact of attracting investors such as Bill that you're talking about, right? So they have, and Carla, like you said, they have 100, 250,000 that they want to invest. So that this allows them to do that, so that's why we set these low minimums, and we can take in a large number of investors. We're capped at, and most funds are capped at roughly 35 unaccredited investors, and an unlimited number of accredited investors.
Mm.
It just offers a really good opportunity to participate in an upside, whereas you may not be able to do a 200 or a 50 or $25 million project. You can participate in some of the revenue stream of what a developer would get, by looking at things like this. And as Bill said, it's important to talk to your investment advisor to make sure it fits within your risk profile and your investment profile. And obviously we can't promise returns, but we've been doing this for a long while, and we've been pretty successful at it and happy with it, and our investors have been happy. So
I encourage everybody to talk to a CPA, talk to an advisor, talk to lawyers. Like before you have an agreement, have a lawyer look at it. Just be aware of any self-serving kind of advice that
measure their own self-interest. Sure.
That's right.
Against your interests. Absolutely.
And one more thing I wanted to say about, limits and if you want to get into an investment and you have a group of friends that maybe only each have $10,000 each. We've had several investors come in as a group, so they'll go out and they'll form their own LP
LLC
or LLC. And and they'll come in with the minimum or more, and as a group, because maybe they only one person has 5,000, someone has 10 or 15 or 25, so they can bring that all together, come in as a group, and still participate.
Wonderful.
And an IRA could be one of the members of that LLC. It's called partnering your IRA.
Oh wow!
Where you can structure you can partner your IRA with yourself. With your spouse's IRA, with other people's IRAs, that exact type of structure where you're bringing your IRA along with other partners and putting it into an LLC, and then having that LLC turn around and make investments in, whether it's directly in real estate or through another like syndicator or fund like you guys have.
Fantastic. Well, I think that wraps it up, guys. Thank you all so much for participating.
All right.
Thank you, Carla.
Thanks for having me. Thanks for inviting me.